So today what I'm going to do, for those of you who haven't heard me speak, one, as you've probably noticed, I don't have any PowerPoint to show you, so you're just going to get a chance to listen to me and enjoy your breakfast. I do try and encourage that this isn't a college lecture course. You don't have to wait till the end to ask questions. If you do have a question, you're free to raise your hand. You're not going to throw me off course or anything. But if you've had all of your years of training from school and said you've got to wait till the end, then wait till the end and we'll take questions then as well. My purpose today is to try and provide you information and insights on the economy. As I've told people all the time when I give my presentations, I'm agnostic as to whether you agree with me or disagree with me. My real goal is just to stimulate your thought process so that you at least stop and think, why do you agree with me or why do you disagree with me? Because it's one of the things I have said over and over again. I would much rather have an informed debate with you than an emotional argument with you. So nobody wins on an argument, but if you at least have the facts, you can have a debate and agree to disagree if people decide that they don't agree with what they've analyzed that way. So my theme for today, what I said, I think I gave a headline for my discussion, but my theme today is headlines versus reality. Because what I continue to see is that, we see from, I guess, all your behavioral psychology, behavioral finance, that bad news is what keeps people's attention. And when you have 24/7 news now that's got to keep your attention so you stay with them, you tend to get fed a lot more bad news than you get fed good news. And so you have a tendency sometimes you get caught up on all of that. And we think even for 2019, we had all of the bad news coming at us about tariffs and trade, about elections, things like that. It's going to continue this year. But the reality is, when we actually look at the economy, businesses are proving that they're still business people who are out to try and be successful and generate a profit, because the economy for the U.S. is still growing. It's not, even though we had last year, we had all the discussion about the yield curve inverted, oh my God, we're going to have a recession. A lot of facts got lost in that, is that even if the yield curve does prove to be an accurate indicator for a recession, the average lead time for that signal is 18 months. And the yield curve inverted last May. So that would say if we're actually going to have problems develop, that would say historically that's been out towards the end of 2020. But the bottom line is the pattern that we're seeing for both the U.S. economy and the Treasure Valley is that the economy is growing, but it is slowing. And I'll give you some of the facts as we go along to show you what I'm talking about there. I do think, as I look at 2020, especially with the potential distractions of the elections, that we will see the economy continue to grow, but continue to slow. And we could end up potentially with economic growth in the 1% type of range, unless we actually see Congress and the president working together to pass fiscal policy to try and stimulate the economy. The Federal Reserve has done all that they can do with trying to lower interest rates to help the economy, but it really takes the two pieces together, fiscal policy and monetary policy. Monetary policy on its own was never designed to stimulate an economy for long-term growth. So where I always come with my information for you to consider, why do I think the economy will continue growing, but potentially slowing? It always, for me, starts, for those who haven't heard me before, I try and keep it simple. One of the advantages I have, I can make fun of economists too, because I'm not an economist by education. I actually have a degree in finance, but about 10 years ago, because the economy affects finance dramatically for a bank, I was the one tracking it the most, and the president asked me then if I would start being the public face to talk about the economy, and they then gave me the title of economist as well. But my grounding doesn't come from all the supply and demand graphs and trying to talk to you about inelasticity of demand and all of that. I mean, that was the worst class I went through in college, is the economics classes. So I always try and say, hey, I'm a street economist. I look at all the facts and the data that comes from all the sources, but I also spend a lot of time throughout our regions talking with our corporate lenders, our retail people, and our customers, what's really going on in the street level. And so what I tell you, the simplest way to understand economic growth in the U.S., some of you, especially I can see the Washington Trust Bank employees, I can have them stand up and they can probably recite it to you because I tell it to them over and over again. And that's the fact that jobs are what create income. Income is the fuel that supports spending. And the U.S. economy, for this whole expansion, almost 70% of economic growth has been consumer spending. So if we understand what's going on with jobs, understand what's going on with income, we'll have a pretty good idea of what's going on with the economy. So when I look at jobs over the last year, what I can tell you is for the Treasure Valley, and when I say the Treasure Valley, I say that because the way the government measures, even though they say Boise, it's from Boise out to Nampa. That's the whole region that they're measuring there. So that's pretty much the Treasure Valley. So when I look at that, what we see is that for the U.S. last year, the latest numbers through November, so that I can compare Boise or the Treasure Valley to the U.S., through November compared to a year ago, the U.S. saw 1.5% jobs growth. The U.S. is still averaging 175,000 jobs per month being added. That's why I always struggle when I hear the national economists saying we are at full employment. We are out of people to find work. They show you the facts that say that we have more job openings than unemployed people. I would say part of the problem with that measurement is you don't capture the people who've stopped looking for work. Because the fact is, the way the government defines you as being unemployed, they say that you have to have been looking for work over the month time period when they measure to say, and they take their surveys, are you employed or are you unemployed? So somebody who's been long-term unemployed, have just said this, why? I'm not going to look until things start to improve more. What the government has basically said to them is, congratulations, you're not unemployed, you just don't have a job. The person's looking at you going, what? So I think that's why we still see this hidden labor pool out there, that we're still hiring 175,000 people. And when we look at least based off of history, I don't guarantee that history repeats itself, but normally what we see for a recession developing is job growth starts to decelerate and we break below the 100,000 a month level. And that's usually what's led us to a recession. 175,000, we've never had a recession at these type of levels before. Doesn't mean it can't happen the first time, but I think I look at that and I say we're still growing jobs. For the Treasure Valley, the U.S. was growing 1.5% on jobs. Treasure Valley, 2.8% jobs growth. So you're almost double the U.S., and that's a pattern that we've seen throughout the Northwest, including all of Idaho, but especially with the Treasure Valley portion of Idaho. Your economic growth, especially over the last 5 years, has been far stronger than the U.S. And there's some of that evidence because you're creating more jobs. The other thing that I say is the type of jobs you're creating also make a difference. Because for the U.S., when we look, if I look back all the way for this whole economic expansion for the last 10.5 years, but especially if I look for the last year from November to November, 69% of the jobs that were created in the U.S. were in 3 industries. The biggest one, 31% of jobs created over the last year were in healthcare. And unfortunately, it's not the doctors, it's the support, the administrative support where most of those jobs are being created. So those are not high-paying jobs. They're not the super low-paying jobs, though. The other section is the world that the CPA firms live in and the other firms that way, lawyers and people like that, and that's professional and business services. And the third one, leisure and hospitality. So the reality for the U.S. is leisure and hospitality is the lowest paying job category in the U.S. Administrative support and healthcare is down in the bottom third for wages. Professional business services is up in the middle to towards the upper third. So the composition there says that's one of the reasons why we have not seen any dramatic increase in wages over these 10.5 years. We've seen wages, first were stuck around 2.5%. Now they've creeped up so that for the U.S., average hourly earnings are now growing at about 3%. For the Treasure Valley, it's 3.2%. Because you're seeing a different mix of jobs. One of the things that you're seeing in the Treasure Valley, and depending on perspective, people say that's great news, and the long-term citizens say that's terrible news, is that you're having a lot of people move to the Treasure Valley. It's become known now, word of mouth, everything else. I think first it started with the fact that Idaho legislature put together the incentive package for businesses that if you bring a new business into Idaho, you get tax credits if you create a certain amount of jobs. But I think then the momentum has grown. They're saying, hey, they've got a labor pool with a university. They're generating talent that's available for those jobs. So what you see for the Treasure Valley is a more diverse jobs growth. For the Treasure Valley over the last year, only 53% of your jobs growth was concentrated in 3 industries. And it wasn't the same 3. It was 2 of the 3. So your top industry was professional and business services. Your second industry was healthcare. And then your third one was not leisure and hospitality. It was trade, transportation, and utilities. That's a pretty big category overall, but that's basically supports trade. You got to get the goods transported, and then your utilities in there as well. So different mix, a little higher paying jobs as well. I think that's why your wage growth has been higher. The other thing that I find very encouraging, because one of the biggest negative news that was played throughout 2019 was the negative impact in manufacturing from all trade war and tariffs. And for the US, that's very clearly true. You talk to people in manufacturing, and they would probably say, hey, we're in recession because we're seeing the big impact from tariffs. And so that's hurt manufacturing. But when I look at for the Treasure Valley, manufacturing for the US for the last year made up 0.7% of the jobs growth in the US. For the Treasure Valley, it's 9.5%. So you actually still have a manufacturing industry that is still operating and still creating jobs, and those are far better paying jobs than something like leisure and hospitality or retail sales or something like that. That helps explain why your wage growth has been better than the US. I think that when I look at for your jobs as well, which categories, even though they may not create the most jobs, which categories have been growing the fastest and the slowest? So what I look at there is that your fastest growing industry over the last year was the world that I live in, financial services. Grew at almost 5%, 4.9% year over year growth for financial services compared to the US's 1.4%. The other sector was the healthcare side. You definitely saw that growing, and it was a little, it matched fairly closely, but the Treasure Valley was a little stronger, just over 3.5%. US is closer to about 3.2%. Again, like I said, manufacturing, I think that just stands out in my mind. If you're growing, manufacturing was growing at 3.5% there, compared to the US saw virtually no growth in manufacturing at all. So I think that that's really something of where I say jobs are important to understand, and what kind of jobs. Because it makes a difference that if all your jobs that you're creating are in the lowest paying wage category, you're not going to have as much economic growth as if you have a good diversified area of jobs growth, so that you're having high paying jobs, blue collar jobs, as well as the lower paying jobs there. And that's a far more accurate description for the Treasure Valley. You do have a better mix that way. So that translated, like I said, into the wage growth, where 3.2% versus 3% is a better growth number, even though the Treasure Valley and Idaho's average hourly earnings are still below the US as a whole. You're still working to get up there. Part of the reason for that, I get asked that a lot, is, well, why? We see we're adding better jobs, we're still progressing, but we're still below that. Why are we still below the national average? And I would say the primary reason why Idaho as a whole and the Treasure Valley are below is because you still have the national minimum wage. 7.7, I think it is, $7.70 an hour, something in that range, compared to, we have seen more and more states throughout that are pushing towards $15 an hour. So all of that low-paying job on a relative basis is higher in your neighboring states, especially for Washington and Oregon. And so I think that's one of the reasons why, because you still do have a decent amount of those jobs, and they are not progressing as much there. And there's no movement so far, at least, for Idaho to say, hey, we're going to raise our minimum wage to $15. And I think that's been a competitive advantage for Idaho as well, especially for the border cities of both Washington and Oregon. I see a lot in Spokane businesses saying, let's see, I'm going to have to pay $15 an hour by next year, or I can move to Post Falls, and I wouldn't have to, I pay half that. So I think those are things that's both good and bad. But as a result, here's the facts that I would tell you about. I said how jobs create income, income supports the spending. If I get to the bottom line and say, what's your economic growth? What I can tell you is the Treasure Valley and Idaho are seeing the same pattern of growing but slowing. But here's the point of reference that I would give you is, in 2017, and I've just got the annual number, so we don't have 2019 yet. 2017, the US had jobs growth of 2.1%. Treasure Valley had 5.3%. 2018, the US had 2.9%. We got the benefit of the tax cuts. We saw economic growth get boosted. So we got that temporary boost there. Treasure Valley benefited, but because they were so strong the year before, Treasure Valley for 2018 was 4.8%. But I still say 2.9% versus 4.8%, you're almost double the US growth. You're a full percentage point better, and it's looking, that's probably what we're seeing for 2019 when we eventually get those numbers. But what I would tell you, if I use Idaho as a proxy, I can get Idaho economic growth numbers on a quarterly basis. They don't release it for the metropolitan statistical areas until a year later. We just got 2018 last week. But when I look at Idaho, Idaho had 4% growth last year, so Treasure Valley was stronger. Idaho's on track right now. For 3 quarters, Idaho's economic growth now is closer to 2.5%. That's a little stronger than the US, which it looks like it's going to be just above 2%. So I would tell you, if I'm just trying to interpolate without any fancy models, we should probably expect that Treasure Valley's GDP growth is somewhere in the 3 to maybe 3.5% range. So clearly slowing from 4.8. But I don't think you can complain too much when you have 3% economic growth. I mean, that is a historical solid number there. But that's a case, again, where I just try and tell people is stop watching the news. Focus on your business. And what I see consistently when I talk with groups and I do these mini surveys and asking them, how's business? I hear very little of saying, man, business really sucks. I mean, there's challenges out there, but most are saying the biggest challenge for small businesses, and we see that from the survey from the National Federation of Independent Businesses as well, the number one challenge for small business is finding qualified help. That's where the problem is, especially in the trade skills, the blue-collar jobs. I've had this, and I've said before I could have a whole hour discussion with you just on this, and the fact that we've got to change the mentality of the parents and the youth of America that a successful job isn't necessarily a programmer writing games for some game company or something like that. And changing the mentality as well of getting the kids to understand, especially that yes, you go into the trade skills, virtually any of them, and you get through the apprenticeship and you're going to be making a 6-figure salary. And they still think, if you ask them, well, what do you think the average wage would be for a plumber or a drywall? Oh, probably $35,000, $40,000. And then when I try and say, no, actually the reality is they're in 6 figures and you think you're going to make all your money as a programmer? Well, unless you graduated from MIT or Stanford or something like that, the average wage for a programmer is more like $35,000 to $50,000. Because so many of them, I talk about that when everybody says, I want to be in tech, I want to be working, programming, this type of thing. Unless you have a pedigree to separate yourself from all the others, where you may find yourself is, which are solid jobs, but they're not the high-paying jobs, you'll be working for Washington Trust Bank on our IT services help desk, and you're helping all the the employees who come and say, I can't get my computer to work, it's not running, or something like that. That's the reality, and yet they have this opposite image. No, it's a boring job to be a plumber. It'd be a fantastic job to be in IT. So I think that I don't know what it takes there. I'm encouraged to see that a lot of states now are starting to offer back through their schools programs that are no longer called SHOP or something like that, but they're these Core Plus type of career tracks where you can, in high school, take the courses that will train you in aviation. They'll train you in welding. I've seen in Spokane for the last month, they've been running ads, they're statewide ads about the Core Plus courses for manufacturing and saying that you complete this, that can lead you to maybe a 2-year degree rather than the 4-year degree, but then a job with a company that's funding those types of programs. So that's where the job challenge is for small businesses. How do I find enough help? And I just try and tell people is, the economic reality is if you may have tremendous demand for your product, but if you don't have enough people to make it, your sales are going to slow. Because either that or you're going to turn to automation and robotics. And that's the threat, I think, for the youth of America. So I think that's where I say for the Treasure Valley, my outlook is no different, is that you've got good things going for it. I think the biggest thing that I would say for the U.S. as a whole and the Treasure Valley, because the Treasure Valley is not going to be immune from the U.S. I keep trying to tell people, just because you're growing stronger doesn't mean you won't enter recession when the U.S. enters recession. Maybe a little later, but you're going to have a recession the same way. So what are the things that we should be looking at that? And the positives that I would say is we have to look at the consumer. The consumer is what's driving this economy, so we've got to pay attention to what's going on to the consumer. Well, one of the things that's driving consumer spending, there's 3 things that I would say. 2 of them I would say are probably good things. 1 I worry about. But 1, we're having jobs growth. We're adding people. The perspective I would give you is that the US added 2,248,000 people to jobs last year. And those average jobs, when I look at the average weekly earnings for the average, for the US, that means that their annual salaries are $50,000 a year. That's 2.2 million people now making $50,000 that we didn't have a year ago. That in itself is fuel for spending. We're not seeing layoffs. When I look at the thing I always tell people is if you want to try and have some indicators of potential problems is keep an eye on the initial, what they call initial jobless claims. That's the initial filing for unemployment insurance when you get laid off. What we have seen is a very clear pattern. It's not perfect. There is no perfect leading indicator. But very consistently, jobless claims start to rise before we fall into recession. Because what normally happens is first corporations cut back hours. If things don't improve, then they start to lay off people. Those people start to file for unemployment insurance. What we would see is that pattern upwards. What we see right now is that pattern is still declining. One of what I would argue, again, the myths of we don't have enough total people to hire, we're not laying anybody off either. Businesses don't want to lose their people because they can't find new qualified help. So jobless claims are on a steady downward path, although flattening out there. So there's no signal from the job side yet that we've got a problem with the economy. For the consumer, that's encouraging. They see jobs growth happening, but they're also seeing wage growth occurring. And especially what we see, what's interesting is, for the US, well, like I said, average hourly earnings are growing at 3%. If you look at the non-supervisory, the kind of the pure production type of employee, it's more like 3.5%. So on a relative basis, they're seeing faster jobs growth, but they've got lower wages. But on a relative basis, again, they're seeing some faster wage growth there. So that's another case that gives the consumer the power to be able to spend. The other side that seems to be driving it as well is because of what we've seen over the last 10 years, and especially last year, dramatic home price increases, dramatic increases in their 401k balances or their investment portfolios. There is a very clear pattern that consumers, when they see their net worth rising, they figure, I'm worth more, so I can spend more. I'm not arguing that's a good thing, because unless you have the income to support it, the other side of that equation of what I say we have to watch out for that could cause the problem for the economy, I worry a lot that we've got this pattern developing now, and not just the younger generation, but very clearly the younger generation, but others as well. Everybody's just focused on the monthly payment. I asked my staff just a quick question for all of them. What did you pay for your cell phone? I don't know, $30 a month. I said, well, yeah, but how much did you? I don't know. They don't have a conception of how much debt they're taking on in many cases, because it's the question is, can I afford the monthly payment? I'm good. I'm going to buy the brand new iPhone 11 or the Samsung 10. I'm going to buy the brand new car, things like that, because I can afford the monthly payment. I think we have to watch there for delinquency starting to rise, default starting to rise, because the reality is one of the threats, I think, for the US economy as a whole, and the Treasure Valley is not exempt from it, has been what I call the rise of variable pay. And people don't even necessarily realize it, but when you stop and think, at the lowest wages, leisure and hospitality, restaurants are booming. I mean, I find it amazing when I come into Boise on a Wednesday or Thursday night, and I better have a reservation, because trying to find a table can be pretty difficult just in downtown Boise. So restaurants are booming. So what does that mean for the food server? Tips are booming. For 10 years, they've had great tips. My worry is, what happens when the economy slows down and you don't have those tips anymore? Same for the goods producing side of the economy, manufacturing, construction, overtime, because of trouble finding qualified help. I talk to owners of construction companies and manufacturing companies, and they say, I worry that I see my employees driving these brand new trucks in, and if I ask them, did you pay cash for that? No, I'm monthly payment, 7-year financing. And so on the white collar side, we have now, the US as a whole has converted more and more white collar employees to variable pay, whether they realize it or not, through, of course, we've always had commissions for salespeople, but we have incentive plans for employees, we have bonuses for employees, we have profit sharing for employees. I just worry that the average employee has gotten so comfortable now for 10 years that they've been getting that magical payment to them, and now they think it's part of their income. And they plan for it as can I make my monthly payment, because here's my total take-home pay, which includes my variable piece, that incentive, that bonus, or that profit sharing. And I just worry that if all they're looking at is monthly payment, what's going to happen, in my view, is that when the economy starts to slow, businesses are going to cut back hours. Suddenly, you're not hitting either the company's not hitting its goals or you're not hitting your goals, and that bonus or that variable piece gets smaller or goes away completely. Not as many people are going to go to the restaurants. We're not going to have as much need for overtime for manufacturing and construction. And I think that's going to be the real litmus test is, can the consumer handle that? Or is their response going to be, whoa, my income's gone down. I still have to make all these monthly payments. So now I have to stop going to restaurants, stop going to movies, stop buying stuff on Amazon. And then those companies see sales declining, and it's just this whole cascade effect then. Those companies are hurt. They start cutting more hours. They start laying off, and that's how you get into a typical recession. The difference is, historically, it's been an inventory issue. Businesses get too optimistic, too much inventory. They have to start laying people off to work off the inventory. This time, the inventory, in my view, is the consumer debt. Getting too much debt, and now they're going to have to work that off the same way. So that's where I would say that's what I want to pay attention to. What's going on there? We're not seeing the evidence yet, although what we are seeing, which always gets my attention, not sure if it gets anybody else's, but we have seen that delinquency rates on subprime auto loans is on the rise. And it's starting to look parabolic, starting to almost get vertical there. So the weakest of the group is under stress now. They're starting to see that stress, but as a whole, everybody, national economists all say, consumer balance sheet's in great shape. And I keep saying, as long as their income stays where it is. It's not in great shape, because when you look at the debt-to-income ratio overall for the consumer, what we see is absolutely what's happened is, with low interest rates, everybody's refinanced their mortgages, and since mortgage makes up the biggest part of your debt, the consumer debt-to-income ratio looks very solid from that standpoint. If I carve out the mortgage side and say, what's about the consumer, the discretionary part, credit card debt, student loan debt, auto loan debt, those types of debt, that actually, debt to income is on the rise. Student loan debt is still rising. We're seeing autos, people still saying, hey, I'm and do it for 7 years, buying new cars rather than used cars, and credit card balances are starting to rise as well. So that's another area I just say we've got to monitor and keep an eye out for, rather than just saying, hey, I was right and it's going to go on this way forever. The other threat that we have to look at is, even though we say we've got a trade agreement with China now, so the trade thing's taken care of, I keep trying to remind people, new tariffs are taken care of. What that trade agreement agreed was, the U.S. is not going to impose the tariffs they were planning to impose in December, and they rolled back the new tariffs they put in place in September. They cut the rate by half. They did not touch the biggest part of the tariffs, which were done in May. So business as a whole is still paying over $70 billion in taxes or tariffs. Because I will tell you once again, for those who haven't heard this, no matter what you want to say, a tariff is a tax. Because the reality is, and I think everybody now understands this, is that if the U.S. has imposed 25% tariffs on Chinese goods, then the U.S. company that's buying those goods, when those goods land on the U.S. docks in Seattle or Portland or L.A. or wherever it might be, U.S. Customs and Border Protection will be there and say to the business picking up those goods, that's 25% you owe. So it's 100% accurate to say the U.S. has collected over $12 billion in tariffs. But we did not collect that from China. We collected that from U.S. businesses. So I'm just saying that's a drag for a business. If you're paying $70 billion in tariffs that you weren't paying a year ago, then can you raise your prices? Or are you going to be suffering your profit margins as a result? Those tariffs have not gone away. Those tariffs are not going away. We are talking about opening another round of negotiations with China, but I worry more that it could be actually the other way, that if China can't live up to what they said, they're saying the number is like 50 billion in new agricultural purchases, when the most that China's ever purchased from the US before was 26 billion. I think the reality is, unless the Chinese economy picks up, they're going to struggle to come up with that number. And if President Trump, especially during election year, is saying you're not holding up your end of the bargain, there is specific retaliatory ability for the U.S. in this trade agreement to reimpose tariffs. So I'm just saying that's still a looming threat out there. I'm not saying that's something that's going to hit, but what the problem is that's impacting business confidence. What we've seen, especially for large businesses, over the last 2 quarters, we don't have fourth quarter numbers yet, but the second and third quarter for the US, business spending was negative. It actually subtracted from GDP growth. Businesses were saying, I don't know what's going on, I'm just going to hold off. And so I think if we can resolve and restore business confidence to say, okay, I can actually start planning now. I know what it's going to be. I don't care if the tariffs are going to be 25%. As long as you tell me that's what it is and it's not going to change, there's not going to be new ones, I can now plan how do I deal with that. But if I don't know if there's going to be new tariffs that will suddenly hit other parts of my goods, or if the tariffs go up, that type of thing, businesses have shown, especially big business, the unwillingness to commit to long-term capital investments. Instead, what they've been doing is buying back their stock. I simply argue buying your stock is great for your shareholders, does zero for keeping you competitive by reinvesting in staying in the most recent technology, most recent products and things like that. And we've seen that from the US. Business productivity has declined steadily, and right now, that to me is the biggest question. If business is still not going to be confident and they're not going to be contributing much to the economy, to put all the burden on the consumer is a one-sided equation there that puts you in far more concentrated risk than you would have if you said all parts of the economy are doing fine. So I think those are the things to pay attention to. I'm not saying those things are going to happen. I just think that I want to keep the perspective is that the economy is growing, economy is slowing, the economy is not in recession, and right now the indicators are not indicating that we're anywhere close to a recession yet. But I think this is the time, I've always said, when the times are good, if your businesses are doing well, this is the time you need to be planning for when the bad times are going to come along. I've used this for the last couple of years, and I'll roll it out again. I apologize to those of you who've heard me, but I still think it's important to have this mentality. I always say I would bet that the vast majority of you for businesses have a disaster recovery plan for an environmental disaster. If you get a flood, you get an earthquake, something like that, you got a game plan that says, okay, here's what we do. For Washington Trust Bank, most of us, we have a little manual that's at home, and we get a phone call from our disaster team and said, disasters hit Spokane, we need to execute our disaster recovery plan. I pull that out, and one step right down the line objectively. I follow those steps, and within 48 hours, we were back up and running, probably in a different location. I would say you need to think of a recession as a naturally occurring economic disaster. They always happen. We don't know when they're going to happen. If we could forecast hurricanes and floods, we'd never have to worry. If we could forecast recessions, we'd never have to worry. I would say you should have a disaster recovery plan in place now for how are you going to respond when the recession hits. Because I think we have to remember, one of the things I try and caution people is, there is a term in economics, it's called recency bias. What that means is our thought process is normally based on what happened most recently. So when I listen to a lot of business and everything, they're saying, oh my God, the next recession is going to probably be as bad or worse than the last recession. And my perspective to you is the last recession was almost the once in a lifetime compared to the Great Depression. That was not your typical recession, and those conditions don't exist now. The easy credit that caused all that is not what available now that it was then. So I would say, and this sounds a little jaded, I'll admit that up front, but this is going to be a normal recession, meaning that it's that excess inventory of debt that needs to be worked off. So we may not see it as severe, and we may not see it as long. But what I do worry is that because we have not had fiscal policy, and we keep now, from a government standpoint, we have both the Republicans and the Democrats who seem to have no issue with deficit financing. Nobody's the watchdog anymore and say, well, wait a minute, we can't spend what we don't have. So our debt is rising. Even if interest rates are low, as debt keeps rising and you roll over that debt and then you're paying interest on top of that, the amount of interest expense will rise because you're just adding to your debt. We now have trillion-dollar deficits and growing. The next recession could well put us into a $2 trillion deficit, and that means that more and more of our tax revenue is going to get sucked up by the interest expense on that debt. So I think that that's just something we need to think of from a disaster recovery standpoint, that if you have a game plan in place, it won't be fun to have a recession, but if you got yourself prepared, the biggest thing we've seen historically forever is that opportunities always arise during the worst of times. But if you're not in a financial position to take advantage of those opportunities, hey, there's a company I can acquire that I couldn't afford before. There's a market I can get into now that I couldn't before. If you're instead more reactive and just saying, God, I'm just trying to survive this, and let's get out the other end, then you miss those opportunities. And I think that the biggest risk that I would see for our economy, the way it stands right now, is that the next recovery may be even slower than this recovery. Because even though this is the longest recovery in history, it is also the slowest. You know, the amount of growth is the lowest that we've had. So it could be even slower next time because the Federal Reserve will push those interest rates right back down to zero again. So savers and retirees are going to get penalized all over again of not having any earnings on what they need to live off of. And we're going to distort the markets in both real estate and the financial securities like stocks again because people are just saying there's the only place I can go to get any type of return. So that is not efficient movement of capital of where it should go to help stimulate an economy. But I just think that's what I would be saying, that if you have your disaster recovery plan, you can respond objectively and rather than reactively or emotionally, and you'd be able to take advantage of those opportunities. So the one thing that I would say for you is that as you look at that, people always ask me, so what's the best economic indicator I should look at? What's the best leading indicator? And my answer to you is there is no best. The best leading indicator is you. Look at your friends, look at your neighbors, look at your customers. Watch for changes in behavior that you're going, you might miss because you're just like, but in reality it's like, whoa, that's unusual. Maybe you better be paying attention. And I had an example that, isolated example, but a case of a friend during the financial crisis that they took vacations every year. And it was always just some exotic place. And then it's like 2006, they're like, we decided to stay at home. I didn't really pay attention to that. It's like 6 months later, they're having a garage sale. Then I'm like, garage sale? I've never seen them have a garage sale before. Well, it turns out one of the jobs was under stress and at risk, and ultimately it got laid off, where if I would have been paying a little more attention, I may have said, we're seeing similar things like that. But I would say the street, real life business, you'll see those changes far faster than the economic data will ever show us. Because at best, the economic data is a month old. And at worst, it's a year old, like for GDP. So if you're paying attention to maybe the payment habits of your clients, the spending habits of your own employees, things like that, I think you'll see a quicker indicator of that than you will from those numbers. And that will give you the alert that maybe you need to start getting ready for your disaster recovery plan. So we've got a sunny day. I'm not going to say we have a sunny economy, but we definitely have an economy that's still growing. And it's very easy to get caught up in all the negative if you listen to the media. So that would be my little sermon on the mount for today, is turn off your TVs, turn off your internet, and you'd be surprised how much nicer your life is. Yes?
What would you say, based on your update, what should the nonprofits expect to see?
The nonprofits are going to face the challenge, one, because their investment earnings are going to be challenged, because it's going to be a case of saying, are you going to put everything into stocks? Because that's the only way you're going to, a lot of nonprofits need something, either like a target over inflation. I'll see quite often, their spending would be like 2 or 3% over inflation, or else it's a 5% spending growth. That's very tough to achieve when you're getting virtually nothing on the fixed income side of a steady thing. So then it says, now you've created variable risk. You say, well, I can get that if I put 60% into the stocks. Problem is, when you get the downturn of the stock market, you still need to make your distribution, and you've lost value on your assets, which would be the worst time to sell them. So I think that the nonprofits will be challenged in that sense, that if businesses, for one, are seeing their sales and things slow down, they're going to be pulling back on the amount they have available to donate, which makes it much more dependent for a nonprofit to try and live off of their investment portfolio. And I just think that promotes risk that a nonprofit should not have to take, but may be forced into it. Other questions? Yes?
Don't you think that most businesses have the same mindset that consumers do? Large corporations are in a lot of debt right now. Do you feel that that's going to be a factor?
I think, so the question is, do I think that the fact that corporate America has been taking on a ton of debt, is that the same problem that consumers have? And I would say absolutely. Why I say I look at the consumers most, on a relative basis, debt's a problem overall. The U.S. as a government has a major problem too. The difference is, U.S. government, you start at the top, they can print money. And so they think, no problem. Corporate America, they're almost of the same thing as saying, given where rates are, I can still convince investors if I just raise the rate on my debt some, I can still get refinanced. Consumer, not going to happen. When you hit your credit card limit, when you spend all your savings, You're going to find any bank or credit union who's going to say, oh, your financial conditions have deteriorated. Sure, we'll give you another loan. So that's why I worry about the consumer first. But it's going to ripple to corporate America, because when they stop spending and sales drop, then they're going to get hit, and it kind of rolls upwards that way. But corporate America, one of the biggest problems I've argued over and over again, the unintended consequence that we've now seen with 10 years worth of data is that by the world central banks, by the fact that the governments of the world as a whole were not passing fiscal policy. They're busy fighting with each other, seeing a rise of populist voting and things like that. The world central banks decided we have to fill the gap. And so they did this through either, one, driving interest rates to zero, and then buying a bunch of the government debt. So what that did was, when you've got low interest rates, you can't earn anything on even your capital that you're investing in, then you're inspired to say, I'll issue debt because it's so cheap. And guess what? I can even issue debt and buy back my shares, and my stock price goes up. My shareholders are happy, and oh, just coincidentally, so is my pay, because my pay is tied to my stock price. So I think that's where I say has been the biggest unintended consequence. It's even worse in Europe with negative interest rates. That's a different world we can talk about, but just imagine insurance companies and others who have to generate a certain return to pay their liabilities for their pension funds and stuff, and they find out that they got negative results there. So I think that's the problem with using monetary policy to try and stimulate an economy versus fiscal policy, where I would argue we have the direct evidence. We passed a Jobs Act and a Tax Cut and Jobs Act at the end of 2017. Economic growth grew by almost 1%. That was true stimulus because consumers actually saw money in their paychecks. Business saw their tax rates reduced. Compared to saying, we're just going to drive interest rates to zero and assume that'll push everybody out of safe assets into riskier assets, which helps those companies then invest in new things, because they didn't invest in new things, they just bought shares. Yes?
So, to use your words, there's at least a normal recession coming. We don't know when, but it is coming. Should businesses start to temper their personal growth to prepare for that, or just ride the wave until it crashes?
So the question is, for those on WebEx, you know the questions. I talked about how this could be a normal recession, but a recession is still coming some point down the road. Should businesses be already tempering their business practices in anticipation of the recession, or should they just keep going full steam ahead and then respond when the recession hits? I think that ties to what I was saying. I would advocate you should be building up your whatever fortress balance sheet, whatever it is for each business. What I've said for many businesses, because they say, well, what does that mean? Should I be building cash? I said, I don't know each of your businesses, but stop and look and see how much were your profits and how much were your sales hurt during the financial crisis, how much were they hurt back 2000, 2002, which was more of a normal recession. How do I need to be structured so I can survive that type of situation? And I would say more of the 2000, 2002. And once you've got that in place, then you should continue to pursue business going ahead. But I would also say this is not the time. It's a Warren Buffett saying, and I think it applies for general businesses, is when everybody's rushing to something, you should turn the other way. And so if you see competitors doing crazy deals, making crazy acquisitions, you're going, I don't even see how those numbers pencil, then you should be saying, I'm not going to do that. I mean, you see the same thing, I can tell you very clearly. I think that's been one of the strengths of being a privately owned bank for Washington Trust. That's exactly for us, is when we see deals being done by credit unions especially and just going, I don't know how those numbers pencil. Then, as our chairman has always said, you'll never lose money on a loan you didn't make. So that doesn't mean you should just stop making loans. You stick with your discipline. This is what's made us successful. I'll continue to do that and go forward. But I've also got my game plan set up. So whether it means I've got to hold more cash, whether I've got to have a line of credit or whatever it might be, but once you've kind of built that disaster recovery plan, then you don't crawl under a desk. That's what I've been trying to tell people, is just because we're saying a recession is coming, well, we know it's going to come eventually. That doesn't mean you crawl under your desk and hide waiting for it to happen, because you're going to probably miss all the opportunities and maybe out of business even without a recession because you let your competitors pass you by. Yes?
What are your thoughts on, you mentioned a little bit earlier about low interest rates. Where do you see 10-year treasuries?
So the question is, where do I see interest rates over the next year? I would say that first we'll start from the Federal Reserve and work our way from there. I think the Federal Reserve feels very strongly they proactively responded to the threats of tariffs and stuff like that by cutting rates by 3 times last year, 0.75%. I think you can talk to most financial institutions, including Washington Trust Bank, and that wasn't anticipated at the beginning of last year. I think because of where we stand with the economy, and especially now that we do have at least a truce on the trade dispute, I think the Fed is very determined to not change short-term rates. We may see one drop if something pops up, but I think they're trying to hold them steady. So I would say what we're seeing from the attractiveness of U.S. securities versus foreign securities, where we've got demand coming in that way. We've got pension funds and others who are buying longer-term treasuries, just trying to at least do something to mitigate their risk with their pension liabilities. I would make the case that I think that 10-year treasuries are going to trade between 1.75 to 2%. They may have responses by short-term things, but what we've seen even at the beginning of last year, who would have made the prediction last year, at the beginning of last year, when we had interest rates on the rise and we were seeing most of the national firms saying that 10-year treasuries were going to go to 3.5 to 4%, and instead they fell almost a full percent, and we're now at 1.8%. I think the demographic features of retirees moving more towards conservative assets, the situation with pension funds and others, I think there's just a kind of a demographic force, and the fact that at least on a published basis, inflation has been very muted, that means that we're going to have volatility within there, but I don't see a condition that we're going to have a dramatic rise. Where I would say I would be concerned for longer term rates is if we actually did start to see a response where wages accelerated, wage growth, because what we've seen historically is that when wage growth gets above 4%, on an annualized basis is when the Fed starts to respond more aggressively then. But we're at 3%. So that's why I would say I think that we're going to have volatility, but we're not going to have a real direction other than between that range. Great for mortgages, great for borrowing, terrible for if you're a pension fund or if you're just trying to invest and get a decent return. Yes?
So you spoke earlier about this possibility of a $2 billion deficit.
Trillion. So the question is, to put it in a nutshell, we see debt still rising. It could get to $2 trillion. Is there some point in time where the bill comes due and the chickens come home to roost? And what I've argued is I think it's very arrogant for the U.S. as a whole. When I listen to our congressional delegates, when I go back to D.C. to say, I don't know what you're talking about. We can finance ourselves, less than 3%. We're the world's reserve currency. And my response is always, well, you know what? The Roman Empire thought that. The Ottoman Empire thought that. The British Empire. All empires or dominant forces, something brought it to an end. And I think we don't have any magic number to say if your debt to GDP gets to a certain level, it causes that. What I would say is where the threat is going to be, there's one of two things. One of the threats is that an alternative currency comes along. Everybody thought it was going to be the euro. It's not going to be the euro. I don't think it's going to be the yuan, the Chinese yuan either for anywhere in the near future until they get an actual rule of law and everything else. So what I keep saying is where I see the threat there for all governments, including the U.S., who have the ability to manipulate their currency because it's fiat currency, it's paper currency, is the right now, Bitcoin and all the others, they're the wild, wild west. They're in infant stages. But the whole concept of what I keep saying is, I don't dispute that. What I look instead and say, what's the message that I derive from that? And the message that I derive is that there are people now saying, I am tired of the government messing with the value of my currency. I want something more like the old gold standard where it's pegged to something where I know it's actually worth something. If that continues to grow, if they build some regulations around the crypto world, that could well be the threat to all governments, is that people move out of their own currency, move into an independent currency, and now these governments have a much bigger problem of financing their debt. The other scenario, which is a more dramatic scenario, may be better news in the long run, but it sure wouldn't be very fun in the middle. Because all the world banks are doing the same problem, we could have essentially a global, they don't want to default, but I've heard the global reset, where you're going to essentially create a new currency or something like that, and you're going to start all over again. The other way they do it, they've talked about it, I'm just like, oh my God, are we really getting to this type of conversation? And we actually have economists now. We have a branch of economics that's called modern monetary theory. I don't know how many of you have heard that, but the bottom line is, what they're saying is, look, you CPAs, you know the world of accounting. Bottom line is, even the Federal Reserve, even though they're independent of Congress, they're an agency of the US government. So, US government issues debt. That's a liability on this side of the balance sheet for the government. Federal Reserve buys all their debt. That's an asset on this side of the balance sheet, and the Federal Reserve by law has to return all of the interest they earn, except what it takes to cover their overhead, back to the Treasury. So why don't we just have the Federal Reserve buy up all the debt for the US and continue to do that, because then we won't have that problem. And I always say, well, we've seen cases like that before. We saw it for Germany especially, and we saw what it did to inflation. People say, well, that's not going to happen this time. Technology and everything else will control inflation. I still say, well, wait a minute. Even under that scenario, all you're doing is kicking the can down the road, because if you actually did that and say, we're going to have all the world central banks agree, they're going to buy up all this debt and say that we're going to own it so you don't have to worry about it. Unless you pass constitutional changes to say, as a condition of doing that, you now have to have a balanced budget, we'll just start all over again. So somewhere it's going to come down the roost. For anybody who thinks we don't need to worry about the debt, I've heard the arguments too is that, wait a minute, that's misstated because so much of the debt is owned by the government itself, like the Social Security Trust Fund owns debt, Federal Reserve owns a bunch of it. And I just say, well, so you're saying then that you're going to tell everybody in Social Security who has Social Security they don't have it anymore if you're going to say that debt doesn't matter, that we're going to wipe it off. So debt is still a problem. It doesn't matter that you're the world's reserve currency. At some point, that would change, and if you don't change the discipline to start changing the message to the populace of saying, we overpromised. We need to reset the clock here. And one of the fastest ways you can do that is by just saying, we're going to do something as simple as changing the age for qualifying for Social Security. And that would cause a riot, people say. But I keep saying, well, it may now, but within a few years it may not, because the bigger voting bloc coming down the road pretty quickly is the millennials. And the millennials may well say, I don't want to pay for everything my parents did. This isn't fair. So I think that that's right now what you have is you can't convince the older generation that we're not talking about changing the benefits of existing people. We're saying we're going to shut the gate down and say it's tougher to get in for future people. And when I've had that discussion with my younger staff, all of them believe they're going to get nothing from Social Security. So even if you said, hey, we're going to make a 90% reduction in Social Security, you'll get 10% of what your parents get. I'll get something, because they weren't thinking they were going to get anything. But we're not willing to have that conversation yet. And so that's where we're back to the emotional side. When you talk about something like that, everyone's like, oh my God, you can't do that. And it's like, well, we're going to have to do something like that, or otherwise we're all going to have it at the same time. Now, we need one more question so we don't end on such a negative note.
Steve, how much do you think the political chaos around impeachment, just Trump in general, is impacting businesses' attitude towards spending and just the future?
I think it's hurt business confidence just because they're saying we don't know what's going to actually happen. They worry, not impeachment. I don't think impeachment, to me, everyone's viewing impeachment as a sideshow because it's already a done conclusion. They worry more about the elections as saying we have a candidate, especially now by the polls on the Democratic side, that is saying free, free, free. And businesses are saying the only way it's free, free, free is they're going to tax me, me, me. And so that's what I think is business confidence that hurts them to say, I'm not going to, why would I do a long-term project? Because you might change the tax rules on me and that project's suddenly unprofitable. I'll just wait. Besides, I can buy back shares while I wait.